Good afternoon, everyone. So it's my pleasure um, to welcome you on board this this last thematic session of this scientific week. And today I have the great pleasure of welcoming a friend of mine, an old friend, Sophie Manigart, for her seminar on meta-analysis of the impact of private equity. Actually, Sophie is incredible and very impressive. Presenting her whole CV would take the whole hour, so I can't afford to do that. And I will simply point out a few very interesting features of her vitae in order for you to understand the type of personality that we have on board today. So Sophie is full professor and faculty dean at the Vlerick Business School and a professor at Ghent University. She has published an amazing number of interesting and impactful papers on venture capital and private equity in general. She has been visiting scholar and professor at very prestigious places such as Wharton School or London Business School, for instance. And she's an associate editor of Entrepreneurship Theory and Practice, which is actually an FT list journal, if I'm not wrong. Amongst other things, I think what is really great is that she also has a very strong connection to practice. In spite of the fact that she's a brilliant researcher, she takes the time. For instance, she's a board member of AXA Belgium. She's a founding member of the ENFIN Association, which is the Academics in Entrepreneurial Finance Research that she founded in 2018. And she's also been one of the pioneering persons who introduced the GEM study in venture capital. So this is really a scholar of choice that we have today. I know that whenever she presents something, this is always very entertaining. And on behalf of Bernard Soulemont and I, we are delighted to welcome you, Sophie, for this webinar, and then later on for the Q&A that we will have internally. I will leave you the floor. You may ask your questions on the chat box or the Q&A, but Sophie is going to answer these questions at the end of her presentation, so don't worry, she will not interrupt herself. And I think that the presentation is supposed to last some 35 to 40 minutes. So I'm not going to talk much more than that. I will really want to welcome you, Sophie, and we'll enjoy this hour together. Thank you, Sophie.
Thank you, Georges, for this introduction, and also Bernard for having invited me for this seminar. I always like very much to come to Liège, be it in person or online. Obviously, I would have loved to meet all of you, but I'm very grateful that we can use technology to connect and to have this kind of webinars. So thanks for the very positive words. You've set the bar very high, Georges. I will try to live up to expectations. I did not realize that you find my talks entertaining, so I did not anticipate that. I hope it will also live up to expectations in that respect. Okay, so let's start. I'll start sharing my screen with you on my presentation. So, what I'm going to talk about is about the real effects of private equity meta-analysis. And this is research that we're still in the process of completing, mainly driven by my doctoral researcher, Jeroen Verbouw. When you have that kind of seniority as I have, you have the pleasure to have good PhD students, and typically they do all the work and I get to do the talking. So that's a nice division of labor. And also Miguel Meuleman, a colleague of mine at Vlerick Business School and at Ghent University is also involved in the project. So this is the very first time I'm going to present this research. So any comments will be greatly welcomed. Nevertheless, I hope that you will find the talk broad enough to be interesting, because we're talking about a meta-analysis. So rather than digging into a really tiny issue that we explore at length, that we delve into at length, this meta-analysis tries to to generate an understanding of a broader research question, see what has been published, what were the findings, empirical findings related to that question, and if we put everything together, what can we learn? What can we learn? Okay. So our overarching research question here is, how does private equity contribute to, on the one hand, the operational performance of the portfolio companies, and on the other hand, on the employment practices in portfolio companies? So our question is driven by the fact that there's quite some research out there on these topics. There's also quite some research on the financial performance of private equity funds. So if you invest in a private equity fund, what are the returns that you may aspire to get? And there the good news is, from an investor's perspective, net of all fees, private equity seems to provide some risk premium. The debate is still out whether the risk premium is big enough, but this is outside the debate we're going to have today. I do realize that this is a seminar in the entrepreneurship field. So my paper today focuses on private equity in the context of buyouts. Now, I want to really stress that, in my opinion, buyouts can absolutely be a really important source of entrepreneurship as well. Not entrepreneurship in the sense of starting a company from scratch and growing that company, but entrepreneurship in the sense of company renewal, rejuvenating a company, instilling new energy, finding new opportunities and new ways to create value. Okay, so this is why I really think that buyouts deserve place in the entrepreneurship landscape, even if some of the companies in the portfolios of those investors are quite old, sometimes more than 100 years old. So entrepreneurship does not by definition have to do with age as only dimension. It can also be extremely important for older companies. So we're not looking at private equity from an investor's perspective, an investor in the fund, but we're looking at it, private equity investors investing in their portfolio companies. What happens with those portfolio companies? Yeah. And the content of my presentation is very traditional. Give an introduction, develop some hypotheses, describe the research methods, describe our sample, and then go to the results and conclusions. So nothing surprising there. But as an introduction, to highlight the fact that buyouts can be really a source of entrepreneurial renewal, I really like the story of TAMINCO. TAMINCO is a Belgian portfolio company, a Belgian company, was a Belgian company, I have to say. And in the old days, until 2003, it was a division of UCB, Union Chimique Belge. At that time, UCB, well-known, traditional, very traditional Belgian company. And it was a division really focusing on basic chemicals. Yeah? At that point in time, around the years 2000, UCB was in a process of transformation. It used to be a fully chemicals company, Union Chimique Belge, what's in the name? It used to be a chemicals company. If you now look at UCB, it is a pharma company. Okay, so it really transformed from a chemical company to a pharma company. Now, in that process, in that transformation process, having a division fully devoted to basic chemicals. Well, the basic chemicals, definitely, that's not very attractive if the strategy is to move towards a full pharma company. So what has happened? UCB set the division up for sale. The company, the division was sold. Actually, it was sold to Alpinvest, so in a divisional buyout. Alpinvest, a medium-sized Dutch private equity investor, just putting the numbers there, 115 million euros. Okay, transaction value. As is typical, after a couple of years, the company was sold again to another private equity investor, CVC. CVC, a pan-European investor, bit bigger compared to Alpinvest. Look at what the value has done. From 115 million, it increased in a couple of years to 800 million. One might say that UCB sold it way too cheaply. Maybe that's the case. Yeah. In that period of time, between 2003 2007, we also saw a boom in valuations on stock markets, helping to explain why portfolio companies increase in value. But next to that, when talking to the CEO at that point in time, who was Laurent Lenoir, he was CEO of the division before the buyout, and he was CEO after the buyout for the full journey. Talking to that person, to Laurent Lenoir, he clearly stated, well, before the buyout, they were really a division within UCB that did not get any strategic attention anymore. So no way to invest, no way to renew, to grow. Yeah? By doing the buyout, they became independent. And obviously, Alpinvest did have a strong incentive for TAMINCO to develop, to create value. And talking to the CEO, he really stated that it was a complete transformation from of the culture within the company. Okay, from just being as efficient as possible to grasping growth opportunities, to grasping opportunities for value creation. That's what they did. And this resulted in a quite nice increase in value, steep increase in value that you typically see for new tech companies. Well, from a boring, very down-to-earth chemicals company, you do see how they could grow in value as well, from 115 million to 800 million in just 4 years' time. That's really an amazing growth. This is really an entrepreneurial change of mindset there. After CVC was also able to further grow their investment, they sold it 4 years later. It did not multiply with 6 or 7 anymore, but nevertheless, they increased 800 million to 1.1 billion. Okay, not bad. When they sold it to a third private equity investor, Apollo. And Apollo now is an American private equity investor, and TAMINCO explicitly was looking for an American investor to be able to strengthen their footprint on the American continent. This is where they really saw further growth opportunities, and that's why they went there to Apollo. It was not such a good deal for Apollo, however. They put it on the stock market. They did an IPO in April 2013, barely 2 years later. So at a loss, but it did not prove to be a very good move of Apollo, because look at that, just 1.5 years later, December 2014, the company was delisted, was acquired again now by a corporate Eastman chemical company, another chemicals company, for a staggering 2.2 billion euros. Okay, so timing and exit mode was not well chosen by this very highly reputed private equity investor, Apollo. If you look from October 2003 to December 2014, merely 10 years, 10, 11 years, the value of TAMINCO did increase from 115 million to 2.2 billion. That's quite entrepreneurial. That's what we call growth and value creation. Yeah. Just a positive story to highlight that private equity can really be the main driver for that kind of stories. It's not all positive, however. Yeah. If you read the financial press, you come across quite negative stories as well. Just one story about Neiman Marcus, the famous US retailer. It was a quoted company listed since 87, but in 2005, it was taken private again in a public to private transaction for $1.5 billion by a private equity investor, Warburg Texas Pacific Group and Warburg Pincus. They did not fare too well. It is not like the TAMINCO story here. In September 2013, there was a secondary buyout for 6 billion. So they had increased the value to some extent, but it took them almost 8 years. So an annual return was not so great. And then later on, just recently, well, the idea was to do an IPO, but it was commented in the press the debt levels are too high. That's obviously a feature of many buyout deals. They are both, the transaction is financed with a huge level of debt. And if everything goes well in the underlying company, there's no problem. The debt can be repaid and everyone is happy thanks to the leverage effect. But if it does not go too well with the underlying company, yeah, then that becomes really a burden. And so it didn't work out, the IPO. Future of Neiman Marcus, when private equity debt meets a pandemic, obviously retail in current times doesn't do well, doesn't match well. And if on top of that you have a huge debt level, then you're really face extremely difficult times. So there was they were declared bankrupt. And there was a first refinancing plan, etc., etc. So two very different stories. One extremely positive story, one story leading to a bankruptcy. We see both. Okay, just like with venture capital, some venture capital backed companies become a unicorn, others go bankrupt. We see the same in private equity. Typically not with that extremes, with those extremes, but it can be very positive or very negative. Okay. So these are just two cases I wanted to highlight, but in the literature, when you look at the literature on the real effects of private equity, well, what does the literature tell you? Let's look at that. So again, from an investor in the private equity funds point of view, typically net returns have been found to be positive. Okay, so we would expect the same positive view on what happens with the portfolio companies. If the portfolio companies do not create value, how could investors in private equity create a return? Nevertheless, we do see conflicting outcomes when you look at the literature. Yeah, and the dimensions that the literature typically looks at is operating performance, EBIT, EBITDA, or the growth of the operating performance. Also productivity per employee, for example, or total factor productivity, these kind of measures. They're looking at employment, what happens with the employment after the buyout. They're looking at the level of innovation, internationalization, etc. So there's very many outcome variables that have been looked at, but the outcome is rather inconclusive. So therefore, we opted to synthesize the literature in a meta-analysis. Okay, so a meta-analysis reviews empirical studies that are out there and aggregates all the effects found in these studies to have one overarching outcome. Okay, so we can take into account heterogeneity among effect sizes. A really important feature of a meta-analysis is that it allows you to introduce moderators for certain effects, for the main effects, beyond those that have been included in underlying studies. And we will take advantage of that because many empirical studies on the performance of portfolio companies after a buyout are country specific. Look at what's happening in one specific country or a couple of countries. Vast majority are looking at the US, the UK. We have then studies on France, we have studies on Belgium, and specifically, if you have studies focusing on one specific country, obviously you do not know how your results are impacted by the institutional environment. It's clear that the institutional environment in Belgium is very different from the one in the US. Can we just translate what the studies in the US show to a Belgian context and vice versa? We don't know that if you just look at single country studies. With a meta-analysis, you aggregate studies from those different countries and you label that. So you create an additional variable like country, where the study has taken place, and that additional variable can be used then in your analysis. So we will take advantage of that. So this allows you to introduce moderating variables beyond those traditionally used in empirical studies to understand under which circumstances some effects may be stronger or weaker. Okay. So these are the advantages. There's obviously also some disadvantages. We are limited to statistics in available empirical studies, and we need sufficient empirical studies with comparable dependent variables to be able to aggregate them into and to do meaningful statistical analysis on them. So therefore, we're not going to focus on innovation. We're not going to focus on internationalization. There's just too little evidence on that. And we focus solely on the broad categories here of operating performance on the one hand and employment on the other hand. Okay, so this is what we're going to do. Our theoretical model, obviously, we start with the basic question: what happens with the underlying portfolio company once a private equity investor has invested in that company? And what happens with its operating performance and with its employment? And it will be moderated. The moderators that we're going to introduce are timing, looking at short-term versus medium-term, pre-transaction ownership structure. The cases I have highlighted in the beginning already signal that there might be huge differences between whether you're buying a division of a large corporate on the one hand, or whether you do a public to private transaction on the other hand, or any other type of pre-ownership transaction. So we'll also introduce that. Third, we'll look at the institutional context. And we'll differentiate between the formal institutional context and the informal institutional context. Okay, given that we put together studies that have been taken place in various institutional contexts, this is something that we really can do in this meta-analysis. And we will control for other variables. I'll talk about those. So when looking at the first direct relationship, impact of private equity on operating performance. When you look at the theoretical underlying reasons why to expect an effect of private equity on the underlying performance, well, then you do see a huge literature that advances agency effects. Private equity investors are really extremely good at minimizing agency costs. Yeah. Further, private equity investors are known to have just one goal, one overarching goal, is to create value, amongst others, through operational excellence. Yeah. And thirdly, once a private equity investor invests, then you get additional resources in your company, and those additional resources enable you to expand and to create value. Yeah? So our first hypothesis is that PE has a positive impact on portfolio operating performance. Second hypothesis, the impact on employment, there we see a different story. Okay, there typically the literature would focus on the negative effects of private equity on employment in portfolio companies. Why a negative effect? Because wealth transfer, how do you enhance operational performance? It can come at the expense of your employees by reducing the workforce, by cutting wages. Quite difficult in a Belgian context, but again, we're looking at studies in very different institutional contexts. So this allows to transfer wealth, to reduce the wealth that is going to employees and increase the wealth to the shareholders. The literature also focuses on the divestments of unproductive establishments. So private equity investor will really scrutinize very strongly whether all the investments, all the assets, all the divisions contribute to value creation. If not, they will divest much more quickly compared to other companies. If you divest, obviously your employee base also decreases. Okay. Alternatively, there is another strand in the literature that would suggest that private equity has a positive impact on portfolio company employment. Yeah, because human capital is a source of competitive advantage, so you want to expand on that. If you invest in your workforce, you will create growth and create shareholder value. So we see the two alternatives. That's why in our paper we also proposed alternative hypotheses. Timing effects, we do think that it will make a difference whether you look at the short term or the long term. Operating performance, their literature is quite straightforward. It suggested that it does take some time for a private equity investor to enforce all its value creation actions. So in the short term, we do not expect an effect at all. We do expect an much more positive effect on operating performance in the medium term. For employment, the story is quite different. Okay, so when private equity investors invest in a company, they will impose their new strategy very quickly, because they do know they only have a couple of years to implement that strategy. So if they want to divest, if they want to get rid of a part of the workforce, if they want to restructure whatever, they'll do so as quickly as possible after the investment. So the hypothesis is that in the short term, employment will be hit by private equity. Okay, either they do nothing or the effect will be negative. But in the medium term, given that they will also favor value creation, growth, etc., in the medium term, initial cost reductions and layoffs may be followed by new recruitments, so employment levels may go up. Okay. Now, moderating factor 2, the pre-transaction ownership structure. Yeah, there we expect that the impact on operating performance will be higher in public to private transactions compared to private transaction. If you take a quoted company private, like the NEIMAN Marcus case, then there will be much more room to reduce agency costs. Quoted company, we have numerous small shareholders who have no say in the operations of the company, who have limited levers to monitor the management team. So there's a huge agency risk between managers on the one hand and shareholders on the other hand. Once you take that company private, the CEOs have a real boss and they know what to do. So they are masters at reducing agency risks in a public to private transaction. When you acquire a private company, however, pre-transaction, the company does not have that kind of dispersed ownership. So the agency risk before the transaction is much lower. So we do expect a lower effect post-transaction for private to private transactions. Institutions, how will the institutions impact what private equity investors are doing? If there is a strong, if private equity is investing in a country with strong investor protection, then we expect that the performance gains will be higher because they will have more possibilities to enhance corporate governance effectiveness, resulting in reducing even more the agency costs, less difficulties to lower a company's cost of capital, and increase its operational performance. So if there's stronger investor protection, we expect the impact to be more positive. What is the impact on labor? In countries where there are more stringent labor regulations, if you compare labor regulations in Belgium compared to the US, you will understand that in Belgium it will be much more difficult to lay off employees, to reduce the workforce, to restructure wages, renegotiate wages, and all that kind of things. So we expect that in countries with more stringent labor regulations, the impact on employment will be less negative. There will be less possibilities to really adjust the labor force. Next to the formal institutions, rules and regulations, there's also informal institutions that we think will be important. Informal institutions like the corporate culture, the overall culture in society, pioneered by the work of Hofstede and colleagues. Yeah. So, for example, there's long-term oriented cultures and there's short-term oriented cultures. Short-term oriented cultures, more like the US. Long-term oriented cultures, more like Japan. Okay. So we expect that the impact of private equity on operating performance will be lower in countries with a long-term orientation. So there will be a higher impact in countries with a short-term orientation. They will be able to execute on their strategies in the short run. They will divest unproductive assets and employees very early on, creating room for shareholder value created later. While in long-term oriented cultures, that kind of cuts in the workforce are not really well regarded. They consider it as a long-term strategic investment. Moreover, in a long-term oriented culture, companies typically engage less in risk-taking, and they do not really value aggressive moves so much. So it will be much more difficult to really change the company. Okay, so we expect operating performance to be lower in countries' long-term orientation, but employment being higher. Second dimension that we think will be important is whether a country is individualistic or collectivistic. Okay, in individualistic countries, individuals engage more in risk-taking. Individualistic countries have been associated with higher innovation, firm productivity, entrepreneurial mentality, etc. So we really think that the operating performance will be higher in more individualistic countries, but employment will be lower. Okay, so again, that wealth transfer between employees and shareholders, that will be stronger in individualistic countries. Now, let's go to our study. What did we do? First step in any meta-analysis is to ensure that you include all relevant empirical studies. Okay, so we did a systematic search to identify all relevant published but also unpublished empirical studies. That's really important because other meta-analyses report that there's sometimes a publication bias. In order to be published, you have to show strong results, significant results, positive or negative. But you also want to capture the studies where the results maybe are insignificant. That adds to our understanding. So to reduce that publication bias, We also looked for unpublished empirical studies, and obviously that will be a control variable in our regressions where publication status will be included. Then we code the effect sizes reported in those studies. We extract all other relevant variables. We eliminate outliers, as you typically do. So how did we go along our systematic literature review? So on the left-hand side, you see all the databases and journals that we scrutinized, also the PhD studies, etc., etc. And on the right-hand side, you see all the keywords that we entered, and that resulted in 16,155 publications. Okay, we did not include 16,000 publications in our meta-analysis. However, we had to filter down, obviously. So we only retained studies based where those keywords appeared in the title, in the keywords, or in the abstract, because those were the studies that really focused on the topic that was of interest to me. We also excluded studies that did not look at the relevant level of analysis. If you have country level studies, for example, comparing buyouts in the UK with the US and France and whatever, we were not interested in that. We really were interested in studies that looked at the underlying portfolio company as level of analysis. And we also only retained studies that indeed looked at operational performance on the one hand, or employment issues on the other hand. Studies needed to report sufficient data to be relevant to us. But we also sent emails to authors of all studies to all studies where we did not find the relevant data. So if they could report then, and that added another 14 studies to our sample. And then we had to remove duplicates. For example, if PhD student A has published his PhD on that topic, and on top of that published a paper on exactly the same sample, exactly the same data, obviously we only retained one of those two, typically the published one. So in total, we have 60 studies, so it's really a very strong filter there. 60 studies, but they report on 337 different samples. Okay, so we may have different samples within one study. So for operating performance, we have 56 studies. We have somewhat less studies on employment, only 29. Yeah. So some studies combine operating performance and employment. So you do see in total, we do have information about 359,000 underlying companies and their effect on operating performance, and 76,000 companies and the effect on employment. Operating performance, let's go to the dependent variable. If you are familiar with the literature, then you do know that there are many, many different ways of calculating operating performance, of precisely defining that. So we included all studies that looked at either sales or cash flows or profits or productivity or growth of any of these previous variables. Obviously, we also controlled for which DV they used. With respect to employment, we took as well studies on the number of employees as studies looking at wages. Okay, and we put those together, again controlling for whether it's the one or the other. And then we have the moderators, timing effect, pre-transaction ownership structure is a proportion of public to private transactions in a specific study, or alternatively, the proportion of private to private transactions. Formal institutions, we used common law versus civil law frameworks from typically Laporta et al. You probably know that. And for the employment, we used the employment law index introduced by Botero, who combines specific country-related laws and regulations related to employment. And then we took Hofstede's well-known long-term orientation and individualism dimensions as indicator of the informal institutions. Okay, so what did we find? At the left-hand side, which you cannot see at all, it's just a plot of the outcome of all the studies. What is the impact of private equity on operating performance reported in all the studies in our analysis? Okay, each of the individual studies. At the right-hand side, I have enlarged a couple of those studies. Why? To highlight the heterogeneity. There's no use of doing a meta-analysis if all the studies are positive, then the effect will obviously be positive. But we saw in our sample that some reported very positive results and others reported very negative results. And the same goes for the impact on employment. Okay, the heterogeneity is even bigger there. You see some very positive studies and some very negative studies. Now, if you have that kind of situation, then there's a real question, what is the real underlying effect? And then we proceeded with analyzing the data with a traditional meta-analysis techniques, the Hedges and Olkins random effects model. We did the moderator analysis in two ways. We compared subgroups. So, for example, a group in individualistic countries and a group with studies in non-individualistic studies, and we compared those two groups, the mean effect sizes. But we also did meta-aggressions where we introduced those moderating effects. And you will recognize them. They very much look like normal regressions. We included a number of controls like publication status, sample time period. There might be effects that in the 80s, buyouts were different compared to the years 2000. We also included for industry dynamics, the private equity activity during the study's sample period. So was it an active private equity market, or was it a really run down private equity market? You know that private equity is very cyclical, so we took cyclicality into account. We also controlled for research method. Was it an event study? Was it a comparison of private equity and non-private equity, or was it just pre and post? Was there adequate matching done if you compare private equity with non-private equity, etc.? Yeah. So we controlled for the different measures of operating performance and employment, as I stated, and transaction years, dummy, as well. First result, which did surprise me very strongly, is that our first hypothesis is not supported. We did not find an effect of private equity on post-investment performance. Okay, neither on performance nor on employment. No effect, not positive, not negative. Yeah. So what we did see is that there's substantial heterogeneity among the effect sizes. I already plotted that. We already saw it visually. It was here confirmed statistically. So we went on to see whether there were situations in which the effects might be apparent, stronger, or positively or negatively. And there we did see, indeed, we did find support for our timing effects. In the short run, there's no effect, neither on operating performance, but also not on employment. So it is not the case that employment is significantly negatively affected after a buyout. We did find positive timing effects in the medium term on operating performance, but we did not find any effect on employment. So if you're used to reading the financial press, which is rather negative after a buyout, well, you now may counter that. A very surprising effect for me is hypothesis 3, where we thought that public to private transactions would have greater opportunities for operational performance improvement. Well, the reverse is true. we do find significant and positive operational performance improvements after a private-to-private transaction and not public-to-private. Okay, this goes completely against my intuition and with what we scanned from the literature. Yeah. Our findings with respect to the institutional context were largely supported. Okay, so in companies with common law and common law countries with strong individualism and with long-term orientation, we find very significant, well, in the first two cases, positive effects on operating performance, and long-term orientation has a negative effect on operating performance. This is fully in line with what we expected. Finally, effect on company employment, common law countries, significantly negative. So not in the other ones, but in common law countries, there's a negative effect on employment. If employment protection is stronger, countries with a higher employment law index have a positive impact on employment. So it's not even zero, it is positive. In more individualistic countries, the effect is negative. And in countries with more long-term orientation, the effect is again positive. So there's definitely a difference depending on the institutional environment in which the private equity investor operates. Conclusion. I'm running out of time, sorry. There's no significant overall effect of private equity on operating performance nor on employment, which is surprising because I had a largely positive view of private equity. After this study, I have to be more nuanced. It's not always positive. In the medium term, there's a positive private equity effect on operating performance. Okay, so I can live with that result. Intuitively, I was not thinking that they would indeed be able to immediately have a positive impact, but it does show after a couple of years. To all critiques that link private equity to negative impacts on employment, whatever we do, neither short-term nor long-term, there is an impact on employment. And then for me, a really surprising result was that private equity has a more positive impact in private-to-private than in public-to-private. Okay, because in private-to-private, we do not start from a situation where there's a huge amount of agency risk. So when thinking about it, we linked it now to the quite new concept of self-agency risk. What is self-agency risk in a company where there's no outside shareholders, where you just have the owner manager? There's no agency conflict in the traditional sense, but there's a self-agency risk in that the entrepreneurs will not exploit the company to maximize value creation. Okay, because they're not aiming to optimize the company, but they're aiming to have a satisfying performance. Okay, so apparently what we might see here at work is that self-agency risk is more important than traditional agency risk in a context of buyouts. If you have a private equity investor, then obviously it's about maximizing, not satisfying. Okay, the institutional context does matter. I'm not going to go over the different results, but indeed, in some environments allow private equity to have a much stronger impact than other environments. So my time is up. I'm available for any questions you might have on this presentation.
Thank you very much, Sophie. Was indeed very insightful, and I was also surprised by some of your results. So I'm sure that there will be some questions. As a reminder, you should type your question, and I will ask Lupe to open your microphone in order to ask it specifically, so that there's no polyphony in this context. Well, while you're thinking about your own questions, I have one for you, Sophie. I've had plenty of questions, but I have one that really struck me. when you're talking about this this cultural context, you have this first the long-term versus short-term orientation, and then you have this individualistic versus collectivist point of view, and you seem to oppose to some extent the operating performance with employment in terms of the focus on value creation. Basically, in the way you present the hypothesis, you have a kind of redistribution which is more to the labor or to the capital. Is it?
Yeah.
But at the same time, I would expect, of course, that some a culture that would favor a long-term perspective would also favor a value creation which is greater overall from a holistic point of view. And here, obviously, opposing employment and operating performance would lead to having 2 points of view on the value creation. But isn't there any perhaps, and that's something that you show, if you were looking sufficiently long-term ahead from the perspective of the deal, and if you were, instead of taking more than 3 years, you would take more than 10 years or something like that, wouldn't these dimensions be reconcilable?
You have a very good point, Georges, and but very difficult to address in a private equity context. If we go again to the TAMINCO case, we clearly see a very, very strong value creation, not over 3 years, not over 5 years, but over a 20-year period. So that company has been able to grow value through 3 different private equity investors, and then being quoted on the stock market on top of that. That's definitely an example of long-term value creation. And I do agree that, well, when looking at Hofstede's dimensions, long-term was indeed not something like 3 years or 5 years for him, but was more long-term in the sense that you're thinking 10 years and whatever. Problem is that private equity obviously does not have a 10-year time horizon. Yeah? Private equity is in there typically, they say 3 to 5 years. If you look at reality, indeed, sometimes they even divest, they exit after less than a year. Sometimes it takes 10 years, but that's not their preferred choice, definitely. So if they have a good underlying portfolio company, they'll definitely seek to exit after 3 to 5, 6 years. So once you have exited, you come in a completely new setting with new shareholders, with new governance, with new underlying dynamics, with a new resource base. And then what's happening at that point in time, now you cannot attribute that completely to the first investor anymore. So I'm not sure how you would solve that empirically. It's a very difficult question. If they still do well, is it thanks to what the first one has done, or is it really the new corporate governance setting that is driving the results in a positive way or a negative way? So I find it quite difficult. Not sure
And
how
do you
you would
have
tackle that.
any usable data on exit? Because the exit would be based on the present value of the future value creation. So in a way, you might have this long-term view by the valuation upon the exit of the investment.
Yeah.
Is it workable?
Do remember that we're not collecting data on the underlying portfolio companies themselves. We're just looking at published studies.
Yes, yes.
So we've taken the outcomes of published studies, and that would require to focus on a different exit, dependent variable, exit, to look at that. We didn't do that.
Thank you, Sophie. We have a very interesting question by Julien Buquers, who is a statistician, and you will understand very easily
okay.
that he is. Julien, can you take the floor, please?
Sorry, yeah. Hi, Sophie. Okay, can you hear me?
Yeah.
Okay, great. So my question is rather simple. It's just that you showed us here that you have statistical significant result for many of the hypotheses that you were testing. And I'm totally fine with that. My question was more if you would know more about also the size of this effect from an economic point of view. Would it translate? So does this statistical significance translate also in economically significant result? And if yes, could you? How would you infer somehow this this economically significant effect?
It's an excellent question. And but I have a very unsatisfying answer. We did not look at that yet. Okay, so I should have done that. I should have done that. That's a question that I would also typically ask because it's not only about statistics; it's about economic underlying significance and importance as well. I didn't do it, so we still have to do that.
Okay, thank you. No problem.
Sorry.
Thank you, Julien. That indeed this is important to have a clue about, of course. But as you say, you're limited by the kind of study that you're making. This meta-analysis, of course, would involve having a deep dive into what they say in terms of this economic meaning as well in very different contexts. Well, I'm still waiting for other questions. I'm sure that Bernard will have one.
Yes, I may have one. Hello, Sophie.
Bonjour, Bernard.
I was just wondering, you know that the private equity is not the same as another private equity. So you may have heterogeneity in terms of profile of private equity. And I was wondering if you think that heterogeneity might be a sort of mediating variable that should, it's not easy given the meta-analysis, but that should ideally be included to explain some of the results. And if yes, do you see any way to take that dimension into consideration in a research like this?
Bernard, again, a very good suggestion and a very good question with a very unsatisfying answer. We could not take that into account because a meta-analysis is, well, it's limited to what you can do. If the studies themselves do not report anything about the type of private equity investor, in a meta-analysis, you cannot start just coming up with something. And the literature so far has not, there's not many studies that really introduce heterogeneity of private equity investors in their study. Okay, so this is something we cannot, with our method, we cannot do. If we would like to investigate that, we had to do that ourselves. I do agree, it's really important. In the most US studies, definitely, there's no talk about heterogeneity in private equity because most are organized like the traditional private equity investor. I think that there's much more heterogeneity in Europe. So we're doing that kind of study in Europe. We would have to go back to doing a first-hand empirical study. In our meta-analysis, we cannot do that.
Okay, thank you.
And I think that the underlying assumption in most studies is that the private equity investor is just a typical independent private equity fund. And it will probably be the case in most of the studies.
Yeah, because there is also, when you look at the data from Invest Europe, for instance, there is a huge variance in the performance of funds.
Yes.
Which could be explained by luck or by the team, or, you know.
No. I do agree with your basic question, Bernard, that the type of private equity fund might be important. But again, this is not something that we can do. So we can add some variables that are typically not included, like institutional variables, but not with that kind of sample-specific things.
Sure. Okay. Thank you.
Yeah.
Sophie, bouncing back on this question, there's also a question about the match and the quality of the match between the management team and the fund. Definitely a fit. You probably remember that Jan Alperovich did part of his PhD thesis on that kind of topic. Is there anything that could be drawn from these studies regarding anything that relates to the personality or to the structure of the company management itself in the effectiveness of private equity?
The studies, you need to have quite a number of studies that are taking that kind of information and that are making that kind of information explicit. And we did not find sufficient studies that made that specifically explicit. We started with trying to understand the heterogeneity of the source of the buyout, because we did know from the literature that there were quite some studies on public to private transactions, for example. And so it was already quite challenging to have sufficient studies where we could extract what the pre-transaction ownership was. So even if that is quite straightforward, public to private or private to private, let alone if you're talking about something like the match between the team and the investors, that's hugely specific. I don't think that there's any meta-analysis at this point in time that could address that. Okay, we need many more studies. So if you want to do that, you have to do a basic study yourself. So a meta-analysis really goes for the big picture. Okay, and the big picture is...
I tend to forget this limitation, of course.
Yeah, it has definitely its limitations.
We actually have two nice questions from younger researchers. I propose to leave the floor to Jérôme Rutte, who has a question about employment and sustainable finance. So, Jérôme, would you take the floor, please?
Yes. Do you hear me?
Yeah.
Hello?
Yeah, we can hear you.
So, thank you for your presentation. It was very interesting. I have a question on sustainable finance. So, in the private market, in the public market, we see that sustainability takes more importance. And so my question is, do we also see this trend in the private market? And you have discussed about the impact on employment. Do you think there is also impact on consumers, environment, and other aspects of sustainability? Thank you.
Jérôme, I like the question very much. It's a really important question. And I cannot answer you based upon my research, because again, there's definitely not many studies out there that look at the impact of private equity on sustainability, etc., etc. But just from my understanding of the market, the importance of sustainability is really increasing very strongly. Basically, at this point in time, there's a survey launched with the Belgian private equity and venture capital investors on the topic of sustainability in their portfolio companies, trying to understand that. And this is something that 5 years ago, we would never have realized that. We never could have done something like that because it was really off the chart. No one was interested in that. It's becoming really more prominent, is getting to the foreground. On the one hand, you do have more and more specialized funds that are impact investors, which you find as well in venture capital as in private equity, who really have as one of the, who have a dual goal, financial, but also creating an impact, positive impact in society. But next to the clear impact investors, you also have the tendency that sustainability, positive social impact creation should be included in the overall investment strategy of any private equity investor. So it's really coming to the foreground.
Yes, indeed, that's clearly a novel topic, and I hope that we will have more insight about the trade-off between sustainability and financial performance in the context of private equity soon. But again, limitation of the study. This is a
Yeah.
You probably will have to do a sequel.
Yeah. Well, there has been a very interesting study published on sustainable venture capital funds. So not private equity, but venture capital, investing in young, high growth oriented companies. And it's just published in 2020, so extremely recent. And compared to traditional venture capital funds that do not focus on sustainability per se, they did show, grossly speaking, that sustainable venture capital funds were able to create a risk premium for their investors. So they had a positive financial performance, but the risk premium was 4% lower compared to that of the non-sustainable counterparts.
So that's more a financial story you have to trade off to some extent.
That's a trade-off. Yeah, and it's a real trade-off. So ultimately positive performance, but less positive compared to the non-sustainable.
Needs to be
non-sustainable,
more documented, probably. We also have, and that will probably be our last question, a question by Nicolas, who questions the effect of size. So I propose that Nicolas takes the floor for this last question.
Hello, Sophie. Can you hear me?
Yes, excellent.
Hi, Sophie. Great talk. Thanks a lot. Very, very interesting.
Thank you.
I had a little question regarding your finding about the private-to-private effect that was positive. Basically, my question was, do you think this effect could be due because in typically private-to-private firms could be smaller, so there could be a size effect, and private equity firms could arrive with a managerial know-how that's more valuable for those types of firms compared to firms that are already public?
It's Nicola, it's an excellent suggestion, and you may be right. Again, this is now speculation and interpretation, because initially we had exactly the opposite hypothesis. So that this was for me a really important outcome of our analysis. And that might be one of the explanations. And it's also to some extent in line with the self-agency risk that I have introduced. Yeah,
because it resonates with the study we're doing with my thesis promoter, Marie Lambert, because we look at employee satisfaction following a private equity buyout.
Okay.
And what we find, one of our findings, is that typically following a buyout, one of the main complaints that comes more often is that one of the complaints that comes less often actually is the lack of professionalism of management, for example, like loose management or bad practices seem to be less complained about. But people would complain about other things, of management being more tyrannical, of being more strict and stuff like that.
Yeah, very interesting, Nicola. If you have a paper ready on that topic, please send it to me, because it's really, I think it's nicely in line with our findings here.
Yes.
And it would strengthen our argument. So if you send it, I can quote it.
Okay, great. Thank you. Thanks a lot. Great talk, really. Super.
Thank you.
Thank you. Thanks for the panelists who asked these very interesting questions. Sophie, I was right when introducing you. It was really entertaining. Very novel from my point of view, because I've never seen any presentation of a meta-analysis of that kind, and I realized that this is very interesting because you basically use the averaging of a number of studies which are worthwhile by themselves in order to have a better view of a global picture, and that I think it is very useful to have these kinds of analysis. I would probably urge researchers in other areas to do the same, perhaps when you have literature that is let's quote it, quote unquote, more mature, that is with many more papers, probably you can dig even further into the hypothesis. I imagine that you're the first ones who try to do that, and that's
on
really
private equity, yeah.
A very, very nice contribution to our knowledge, not only on literature, but I think, and that was really the purpose today, also on our global understanding of what research can bring for our, the big picture that we have of private equity. I would love to see that on venture capital, and especially on startup funds, but
it exists, Georges.
Okay.
Jan Brinkman has a paper, a meta-analysis on venture capital in Journal of Business Venturing. I do think in 2016 or 2014 or something like that.
I will have a look at that definitely, because that's the kind of literature that brings really insights to what we try to know from a more micro perspective. So thank you for this very interesting talk, and that raises a lot of questions. It was surprising to see how many of your hypotheses are not met. So we need to understand better definitely what's going on here, and you have very nice suggestions for that. Thanks for all the participants to this session. I know we had a very distinguished audience from the names that I see on my list. I hope to meet you again on Friday for the final discussion that we will have with the committee. But in the meantime, I hope that you will join me in thanking Sophie for her very, very nice presentation. And Sophie, you're always welcome at HEC, physically or not, the way you want.
Thank you, Georges. It was really my pleasure, and I enjoyed all the very interesting and tough questions.
Good.